I am Kyle Houtman, Executive Director, Main Street Growth Project, and really excited to have you all here. Looks like we have quality and quantity. Thanks in particular to our special guests today, Arkansas Senator Tom Cotton, CFTC Commissioner Chris Giancarlo, and SEC Commissioner Mike Pivovar. The Senator's folks have contacted me. He's got two events. He's going from one to the other here in the CVC. He's down the hall in the classified room and should be here, I haven't told, in about 20 minutes, okay? Bit of a housekeeping here. By the way, if you want Wi-Fi, it's Senate guest. The password is constituent with a capital C. The hashtag for this event is MSGP, as in Main Street Growth Project, okay? You can follow us on Twitter at Main Street Growth, Main SG Growth, and the website is the same thing, mainstreetgrowth.com, mainsggrowth.com. One other thing to note related to this event is this morning in The Hill, which I'm sure many of you read, is my op-ed, Big Government versus the Little Guy. Please check that out. That is mostly about banking and how big government has harmed that which it is supposed to protect and wind up helping folks it was not intended to help. If you don't know us, Main Street Growth Project, we are a nonpartisan, nonprofit advocacy group. We're focused on pro-growth financial regulation. And I took this job about a year ago because we did not seem to be, from the advocacy standpoint, somebody standing up for the little guy talking about all of the collateral damage that is happening. People caught in the crossfire that did not cause a financial crisis, but were getting weighed down by regulation that was not supposed to be about them. We support free enterprise via policies that are fair, void of cronyism, that help Main Street businesses, workers, and consumers. What this means principally is two things that we're about. Number one is reforming Dodd-Frank in a common sense, pro-growth manner. The second thing is to allow the growing financial technology industry to grow unencumbered and with policies that promote maximum competition. Financial technology, people call it fintech, who are in the know. If any of you use Venmo, that sort of thing, Lending Club, borrowing, investing, it's an industry that is new, it is thriving in America, and we want maximum competition and try to get in front of the coming Uber versus taxi sort of arguments over who can do what. So we have about 20 minutes before Senator Cotton, and I'm privileged to introduce our two commissioners. First up, we're going to have an opening statement from Commissioner Mike Pivovar. He's been on the SEC since 2003 and has consistently been on the side of the small investor and small and emerging companies. Dr. Pivovar served as an economist on a Senate Banking Committee, and I mention this because apparently he's one of only 3 trained economists to ever serve as an SEC commissioner. It's a position that's usually filled by lawyers. Commissioner Pivovar has been a thoughtful voice in particular when it comes to the ongoing implementation of the Jobs Act. And I'd like to mention the Jobs Act for a second, because that is exactly the sort of thing that Main Street Growth Project wants to see happen. It was bipartisan. President Obama signed it in 2012. It was a process to get there. It took some advocacy. Jobs Act is JOBS, Jumpstart Our Business Startups. If any of you are familiar with crowdfunding, that is one of the issues that it addresses. And Mike Pivovar has been central to a thoughtful implementation of that. This is a kind of reform that is possible if we don't fall in love with our first drafts, if we work together on common sense goals that are pro-Main Street. Please join me in welcoming Commissioner Mike Pivovar.
Great. Thank you, Kyle, for that kind introduction. In fact, I think, wasn't yesterday the 4th anniversary of the Jobs Act, if I remember correctly? So fantastic. Before I begin, for those of you that ever heard an SEC commissioner speak, you know what's coming next. I need to state that the views I express today are my own and do not necessarily reflect the views of the Securities Exchange Commission or my fellow commissioners. As many of you know, the SEC's 3-part mission is to protect investors, maintain fair, orderly, and efficient markets, and facilitate capital formation. And every day, over 4,000 of us at the SEC go to work in Washington, D.C., and 11 offices throughout the United States with one singular purpose in mind, and that is to fulfill that mission. And for me, what that mission means is no less than protecting the American dream. For some, the American dream is putting their entrepreneurial spirit into action. starting with a new idea for a new product or service, taking a risk, starting a company, hiring workers, and bringing that new product or service to market, and then convincing others to take a risk with them and invest in their idea, their company, and in their workers. And along the way, improving the standard of living for the workers they employ, the customers who buy their products, and the investors who share in their success. For others, the American dream is taking their hard-earned savings from their income, from their jobs, and investing in the companies started by the entrepreneurs, and using the proceeds from those investments to improve the standard of living for their family by paying for their children's education, to improve the standard of living in their community by reinvesting in other local businesses or donating to their favorite local charity, and to improve their own standard of living by seeking to achieve retirement security. Unfortunately, almost 6 years ago, a 2,319-page nightmare called Dodd-Frank was unleashed, threatening the American dream for millions of Main Street families and business owners. Among the hundreds of provisions that have nothing to do with the financial crisis, Dodd-Frank forces the SEC to divert our substantial resources from our core mission, and instead to implement special interest disclosure provisions that have nothing to do with helping investors or entrepreneurs achieve the American dream. As I've said before, investors should be rightfully outraged when corporate executives use company resources to unduly enrich themselves at the expense of shareholders. But investors should be equally outraged when someone else tries to use corporate assets to advance their own special interests. It is simply wrong to use the power of government and other people's money to achieve their own personal gains at the expense of shareholders. Dodd-Frank's focus on non-material special interest disclosure provisions such as resource extraction, conflict minerals, and CEO pay ratio is a deplorable corruption of the SEC's core mission. The SEC's disclosure regime must serve Main Street investors and entrepreneurs, not politically connected special interest groups. America needs small and medium-sized businesses to grow the economy, create jobs, and improve our standard of living. Excessive and unnecessary regulation harms the investors, customers, employees, and entrepreneurial founders of Main Street businesses. The unintended consequences and collateral harms of regulations issued under Dodd-Frank must be addressed. And the SEC must return to its core mission of protecting investors, maintaining fair, orderly, and efficient markets, and facilitating capital formation so that we can all invest in the American dream by investing in each other. Thank you.
Thank you, Commissioner. That was excellent. By the way, in your introduction, I probably should have mentioned one of the things I like most, Commissioner, is the acronym FSOC. That is the Financial Stability Oversight Council. Am I correct? You came up with Firing Squad on Capitalism. Is that yours?
That's correct, and that was one of the nicest things I said about it.
The Star Chamber, that was another one, right? It is such an unsexy topic sometimes, but so important. Financial regulation in general, Dodd-Frank. When I go around to people around the country or talk to people who have normal jobs, and you ask about Dodd-Frank, they think I'm talking about a country western group or maybe a law firm. Nobody has any idea what I'm talking about. The SEC is obviously a football conference with Alabama in it. But this can't get any more important than what it is. I literally think it's the American dream. I think I'm not overstating, especially given the impact on recent immigrants. Next up, I'd like to have Commissioner Giancarlo. I served with the CFTC since 2014. I think was sworn in by Justice Thomas. Before serving on the CFTC, Commissioner worked in New York and London for many years, both at law firms and with the financial services firm GFI. He's testified in Congress a number of times, giving many speeches talking about regulation's effect on the little guy. In the case of the CFTC, it's often dealing with farmers, ranchers, small commodities merchants, and other small businesses. Please join me in welcoming CFTC Commissioner Chris Giancarlo.
Well, Well, thank you very much. And I should begin with my own disclaimer that the views I will express will be my own views and not those necessarily of the Commodity Futures Trading Commission, my fellow commissioners, or the CFTC staff. The area that my agency oversees, and that is derivatives, listed derivatives that trade on futures exchanges and over-the-counter and other derivatives, often known as swaps, is considered, I think, by many people somewhat of an arcane subject. So I thought that this morning I might begin by just trying to maybe demystify it a little bit. Mike Pivovar talks about his agency overseeing the American Dream, which is exactly what it does because it's a regulator of investment markets where people invest their hard-earned savings for a future return, for their own retirement, and for their children and their grandchildren. The derivative markets play a different role in the economy. The derivative markets are where participants in the American Dream go to control the risks of their production, to control the risks of their business activity. Well used in the agricultural commodities space, but used in every facet of our American way of life, and actually are integral to the American way of life. And I thought I might give you sort of a simple example. I had the interesting pleasure to go to Czechoslovakia a few months after the Iron Curtain came down in late 1989. And we were staying in an apartment and there was no food. So we went down to the local supermarket to try to put something in the refrigerator. The shelves were empty. There was no fresh produce to speak of except for some grapefruits. Apparently Cuba, which was an ally of Czechoslovakia in those days, exported grapefruits, and that was the only fruit that was available in the Czech supermarket. Well, that's a market based on coercion, not a market based on consent. There was no ability of the marketplace to satisfy the needs of the Czech people, let alone visitors from overseas. I came back to the States and was delighted to walk into my local supermarket and just see an abundance of food on the shelves of every kind, especially fresh produce. Well, why is there fresh produce then and today on the shelves of American supermarkets? Do any of us ever walk in the supermarket and ask ourselves, was it a good season out on the farm? Was this a good growing season? Will there be bread on the shelves? Was it a good growing season in the fruit section of the country, in California and others that produces fresh fruits and vegetables for us? Will there be fruit on the shelves? We never ask that. And yet, invariably, there are good growing seasons and bad growing seasons. In fact, if you go to the developing world, if it was a good harvest, there will be fruit and vegetables and fresh produce on the shelves. But if it was a bad harvest, the shelves will be empty. And worse, in the developing world, if it's a bad harvest this year, many of those farmers will go bankrupt, which means they won't plant next year. And as good as next growing season may be, there won't be enough food because the farmers that needed to make money this year selling their goods won't have the ability to buy seed to put in the ground next year. So why is it that in our wonderful country, we never have to think twice about whether it's a growing season? And the answer is because our farmers can hedge the risks of bad weather with derivatives. They can hedge the risks of fluctuating energy prices that they need to fill their tractors with gasoline with derivatives. They can hedge the prices they will get at harvest time. They can hedge it at planting time. They can hedge what their produce will earn for them in the marketplace. They can hedge it today for tomorrow. That's the role the derivative markets play in our world. They make sure that we have adequate produce and groceries on the shelves year in and year out. But they do a lot more than that. They're the reason why we have the conventional mortgage in America is a 30-year mortgage. Well, interest rates are going to rise and fall during that period of time, but mortgage lenders can use the derivative markets to flatten out those changes so that we can get a fixed rate mortgage. They're the reason why we can get fixed payments on auto loans. They're the reason why John Deere can offer farmers terms on buying a new combine or a new tractor that are tailored to the needs and to the income levels of their farming constituents. So derivatives play a very, very vital role in the market. Out of the financial crisis, there was a lot of concern about banks trading in swaps and other derivative products, as there should be. And there should be appropriate restrictions and regulation in that area. But we cannot forget the very, very important daily role that hedging markets and derivative markets play in all of our lives, in all of our financing activities, in all of our just daily activities, from shopping for goods on the shelves. And we need to make sure that a regulation that was designed to curb Wall Street excess doesn't impact the daily activities of America's farmers, of America's lenders, of America's manufacturers that need to use these products to hedge the risks so that we can all enjoy the way of life that we have. So I'm really looking forward to today and our discussion with Commissioner Pivovar and to talk a little bit about some of the unintended consequences of some of the regulations which we'll go through that were designed to curb Wall Street excess, but are already having an impact on these everyday activities of America's farmers, ranchers, smaller manufacturers, small community banks, small lenders to the agriculture and the manufacturing sector, far, far away from Wall Street. So thanks very much.
That was excellent. My sentiments exactly about when Rahm Emanuel said we don't let a good crisis go to waste, talking about a 2008 crisis. I understand his sentiment, and things had to be done. But does anybody here really think that those ranchers caused a financial crisis? Then why on earth are they getting hurt by what was called the cure? Somebody who's just graduating high school this year is going to go look for work. They're part of the majority of Americans that don't get a college degree, and they're looking for a job. Did they cause the financial crisis of 08? They were 10 years old when it happened. Millions of recent immigrants who weren't even in this country, did they cause a financial crisis? No. So why are these folks getting hurt? That is the title of this event, Collateral Damage, How Main Street's Getting Hurt in the Fight Over Wall Street. To talk about what we are for, the answer is we're for anything that alleviates the pain that we just said. Community banking regulations, they are being treated as if they're big banks. Those need to be reformed to better size them. The FSOC/SIFI regime, that's systemically important financial institutions. Reminds me of the Kevin Costner movie No Way Out, where they don't let anybody get out of there. The Hotel California, you can never leave. It's a very strange, strange set of things that everybody in America ought to demand accountability and transparency from our government. It's a little hard to connect to the average person, but the average person can understand when you are labeled systemically important. Now, the point is we're not supposed to have too many of them, right? Because it's dangerous. You ought to want to give people steps to not become one, and once they enter the Hotel California, you should be able to tell them how to not be. Remember, the goal is to have fewer of these, right? Imagine you got a letter in the mail that said, the IRS, hey, you're not in good standing anymore. Your 2014 return has a problem. Yep, you're not in good standing. And you ask, what's the issue? Was my dividends, capital gains, charitable? And they won't tell you. They won't tell you how to fix it. You can just keep refiling over and over again at your time and expense till maybe they let you know you got it right this time. You got lucky, right? That is akin to what the FSOC/SIFI regime is. I understand why Commissioner Pivovar speaks the way he does about it. I think we get the general notion of it, and there are ways to reform it that don't even repeal Dodd-Frank, that ought to be bipartisan. There are bipartisan bills out there right now. Ross Delaney is one that we are behind, and we're going to try to push for people to support and talk about who is and who is not supporting this common sense reform. I'd like you to imagine, if you will, just to give you the big picture and why we're tying so many of these things together at once. Imagine a town that's had a tough time, and the main street's got some empty storefronts. You may be from a town like that yourself. Somebody in that town wants to take advantage of the low rent and open a business. Now, she has a better than average chance of being an immigrant, being that immigrants start businesses at double the rate of the native born. And one night she wakes up, middle of the night, and says, I've got it, I got my idea. She's literally living the American dream. That's where we come in. What is happening in this city that is helping her, and what is hurting her? What can we do about it? And I don't think the American public realize, because they were sold something that was a little different in Dodd-Frank, and again, we're not just about Dodd-Frank, don't realize it, because there are folks getting hurt, and people just want to go after what they consider the bad guys and not realize everybody else is getting hurt. The community bank, where she's likely to ask for a loan, say $20,000, $30,000. Big banks often don't want to do these, okay? That press release that was on the seats and got passed around has a graph of, since the recession, big company financing and small company financing. One line looks like a terrific recovery. Went down in 08, recovered strongly. You know what it looks like? It looks like the S&P 500. It looks like big companies, okay? There are other graphs we have. My board member, AEI scholar Peter Wallison, has a number of these measuring capital markets financing versus loans. Only the biggest companies can do that. And it's pretty nice, right? If you're a big company and you can take advantage of the cheap money we've had, it's also pretty nice when you don't have much competition because our new business starts have fallen. That is where job growth comes in, the new businesses. Everyone says small businesses, but it's new small businesses, okay? So who is hurt the most when we make it difficult for a community bank to give that woman a loan? Who needs a job? Someone doesn't have them. Who's entering the workforce? Young people, recent immigrants, and somebody returning to the workforce, often a mother going back to work. Everything we do that inhibits that small business loan, that does not allow the market to work, is hurting those groups the most. And I challenge anybody who's in a position of power to think about that when they go home at night. Over and over again, Commissioner Pevermore mentioned the investor side of it. We see the big guy getting helped in D.C. and the little guy getting hurt. And by the way, D.C. is included in the big guy. This city is thriving, right? We have better restaurants every day. And to put it mildly, this city does not produce the economic value that other cities do of its size. Is D.C. helping investors and entrepreneurs with a policy? It's the official government policy that only the 1% can participate in the best startup opportunities? Does it help the person who wants capital to limit the pool to a small group of people? What I'm referring to is the accredited investor rule. I have the privilege of serving on the SEC's advisory committee for small and emerging companies, and one thing we talk about is that. I mentioned that woman who had the Eureka idea. Let's say it went big. Let me ask you this one. Anybody hear of Oculus Rift? Anybody hear about them? They're video game technology, right? 2012, I'll keep this one short, but long story short, the guy went on Kickstarter, said he wanted a couple $100,000, raised $2 million, got it off the ground. It's virtual reality headsets, right? It's gonna be the next thing in video games, right? Got $2 million, got it off the ground. 2 years later, sold to Facebook for $2.4 billion. The people who gave the $2 million put in $500, $600, $1,000. I think the average is about 600. Some people put in a couple thousand. That $2.4 billion got made by the professional investors who came in later. They got a 20-to-1 return after it had gotten off the ground with that money from Kickstarter. No one was allowed to get any equity. That was our government's policy. Who was allowed to invest later on? The people who had the capital, who were accredited investors, and who had the connections to get into that fund. We don't really know because they never got actual equity, but what I'm told is they would have gotten 100 to 400 times their investment. Can you imagine that? You put in $500, you're a video gamer, and you get 400 times that, you have $200,000. How about shaking up the 1% and providing retirement security? Anyway, that is an example of, at the investor side, what I think we can do if we pursue good policies. Do we really need to have a protection racket for the wealthy and the best connected? What would a map look like of the people who made money from that? It would look like America. It would look like people sending in money from wherever, because all you need is the internet. You know what the map did look like? The people that made that billions of dollars? It looked like a map of 1% is what it looked like. And that's one reason we're here. The people who not only have the money to get into those funds, but knew the right people. Some of us, if we had the money, wouldn't even know who to call. So why do we want to make that our official policy in an era where we talk so much about inequality? And I think it's right that we do. Going from the investor end to the checking account side, there was a thing when I was a kid called free checking. It was really free. It was easy to get. And I remember putting a roll of quarters up on the counter and getting free checking. That's gone down by about half. We now have higher minimum balances, and that hurts almost everyone. And again, it hurts the little guy the most, who can't afford the $12 a month I have to pay after taxes, who can't afford the $1,500 a month I have to have in my account for the minimum balance that I can't invest, I can't use. That hurts the little guy over and over again. Why are we doing this? Why are we helping out the check cash pace and hurting the community banker and hurting the least among us? I know Senator Cotton is here. It is an absolute honor to have you here. I know you have a tight schedule today, so we appreciate it. I will let you give your opening remarks, and then we'll take the time you have to sit here. We're honored to have Senator Cotton today from Arkansas. Been fighting the good fight his whole career. It's quite a distinguished resume, but I'll keep it short. Served 5 years on active duty in the U.S. Army as an infantry officer, completing combat tours in Iraq and Afghanistan. In 2012, he was elected to the House of Representatives, and 2014 was elected to serve the entire state of Arkansas as U.S. Senator. As a member of the Senate Banking Committee, Senator Cotton fights every day for the workers, farmers, small businesses, and community banks of Arkansas and the rest of the United States. Please join me in welcoming Senator Tom Cotton.
Cal, thanks. Thanks very much for the kind introduction, and thanks. I'm fine here. Thanks for the warm welcome, everyone, as well. Since I'm running a little bit late and have a tight schedule, I'll keep it short. I just want to thank the Main Street Growth Project for hosting this event and for inviting me to participate. I believe the mission is very important to give voice to those who often don't have a voice in the halls of power in Washington, D.C. So in an event like, also hosting an event like this to bring together key decision makers, policy experts, other stakeholders that help amplify the voice of the folks on Main Streets, those farmers and the ranchers who have stories about the injuries that excessive regulation in our financial system has caused them in their day-to-day lives. I also want to thank Commissioners Giancarlo and Pirawar for being here. They were distinguished professionals outside of their government service, and now they're equally distinguished inside their government. Thank you very much for taking the time, the sacrifices that you have undertaken. And finally, I just want to say that you may have noticed that legislating in the Senate can be a little slow and hard, but that's the way our founding fathers designed our system of government. They wanted a government that would be safe, not necessarily efficient. The wheels of legislation can grind slowly in the Senate, maybe particularly slowly in the Banking Committee these days. But that's not all that we do in the United States Senate. We also conduct oversight, especially oversight of agencies that sometimes tend to run amok. Tomorrow morning, we're going to have Richard Cordray from the Consumer Finance Protection Bureau, and I'm sure that we'll raise many of the issues that are going to be discussed in this forum today, many of the issues that are hurting those farmers, ranchers, small businessmen, families, and communities back home in Arkansas. So thank you for letting me be a part of this. Thank you for hosting it, Kyle, and now I'll turn it back to you so we can talk.
Sure, and you've got a hard stop about 12:50, is that right?
We can get 12:55.
All right, fair enough. We'll take what we got. This is a conversation, so you guys feel free to join in. But the first thing I want to ask the senator is, there are some bipartisan bills out there to help community banks, to exempt them from some of the things that I think the average person doesn't even realize they got hit by in a Wall Street Reform Act, right? What do you think is possible, or what is stopping the bipartisan reforms from being passed, either signed by the president standalone or as part of a larger package?
Well, I think in large part it's obstructionism from Senate Democrats. I also served on the House Financial Services Committee when I was in the House of Representatives for 2 years. Many of these bills passed that committee with large bipartisan majorities. Some of them even passed in the House of Representatives on what's known as the suspension calendar. Without extended debate, it passed with more than a 2/3 vote. Those bills seem to go to die in the U.S. Senate when the Democrats were in control, but now as well, unfortunately, with Republicans in control, in part because the Democrats have the ability as the minority to gum up the works. Certainly on a large regulatory reform bill, like Chairman Shelby wrote last year, but even on some of these small individual bills. I wish I could say I'm optimistic that some would pass. I don't think I can say that, given the limits of the Senate schedule. Perhaps, though, some of the more targeted reforms, like addressing the qualified mortgage rules, the ability to repay standards, might be included in appropriations bills. And we do plan to move to the appropriations process this year, earlier than any time in recent memory. So I at least have some glimmer of hope there.
Would you say it's a perception, or even what the senators and congressmen think, that they're afraid of doing something that might be perceived as pro-bank or pro-Wall Street, right? When what we're talking about are, for example, qualified mortgages, allowing very good mortgages into the system, which we should want. Is it that perception?
It's hard to get in the heads of my Democratic colleagues sometimes. I think part of it is as you have seen with Obamacare as well, is a political desire not to put any chinks in the armor of one of the president's lasting legacies. They had massive majorities in 2009 and 2010 during the president's first 2 years in office. And since then, their legislative agenda has really been to stop any further action that might whittle away at those achievements, the stimulus, Obamacare, and Dodd-Frank. So Senator Reid has been running interference for the administration since 2010, essentially letting the regulatory agencies of this administration implement those laws. So even when you have, in my opinion, very, very clearly unintended consequences. I think Barney Frank has even said this at times. But in Arkansas, for instance, we have a lot of families that need to finance the purchase of mobile homes. There's not a lot of rental stock in a place like Yell County, Arkansas, where I live. There's not a lot of new construction either. Sometimes single-family homes are a little bit large for a family in their 20s with one kid. But because of the ways that the various ratios are calculated in the, for a mortgage and the lower cost of mobile homes, you get couples that are priced out of buying their first home. And I know many older couples now who live in single-family homes, sometimes very big, nice single-family homes, who 20 or 30 years ago started out in a mobile home. That to me seems like a very simple problem that should be fixed on the suspension calendar in the House under unanimous consent in the Senate. Yet we just never seem to get the kind of momentum that we need on small but important fixes like that for the places I represent, and frankly that all senators have. I mean, even the senators from California and New York and Massachusetts represent a lot of rural areas that are really being hurt by the impact on small financial institutions in their hometowns.
Commissioner Giancarlo?
Yeah, you know, there's a parallel in the world of the Commodity Futures Trading Commission to what we're seeing on the banking side with the diminishment of small community banks. We're seeing a diminishment of what are known as futures commission merchants, which are essential elements between in the relationship between a farmer and his or her transactions in the futures market. They rely on futures commission merchants, or as they're known as FCMs, to be the interface between them. And in the 1970s, we had over 400 of them here in the United States, for everything from large ones to very small ones that would work regionally with local farmers and manufacturers. Well, at the start of the crisis, that number had gone from 400 down to a little bit over 150. 8 years later, we're now down to 55 active futures commission merchants, and of that, 70% of the activity is with 5 very large ones based in, guess where? New York City, Wall Street. So farmers in your state and elsewhere are finding that their choice in who they can go to advise them in some of these important hedging decisions are no longer based in their home state or in a local city. They're far away in New York in the form of big firms that, quite frankly, don't even really want to deal with these smaller clients and don't have the ability. So that's another unintended consequence that we've just got to get right.
And I'll chime in there as well. Arkansas, over my lifetime, has gone through a lot of bank consolidations, but even more so, I'd say, over the last 6 years. You know, there's a small town north of my hometown called Dover. I was there a few nights ago with my wife doing some target practice. But there's an old bank branch there. It's now a city government building, and a few years back it closed up. And there's a sign on the marquee that said, "Now serving Dover from Russellville." Well, the people in Dover didn't think that was a very good service, and that's in part they feel that way because the community banks really are a part of the community. They're the bank, or they're the organizations that help fund Little League uniforms or scoreboards at high school football fields. You know, they have people who are sitting on the local library board or the local hospital board. They really do have a sense of community. Big banks have their role in our society and in our world, but oftentimes they just don't see the value in serving a community like Dover with 1,300 people, or my hometown Dardanelle with 4,600 people. That's the role that these smaller institutions play in our society. And it's a very, very important role.
Yeah, and nobody thinks that those folks were at the mobile home caused a financial crisis. And a lot of people.
Well, that's, you know, in Arkansas, you know, people ask me if there was a housing bust in Arkansas, and I said no, because there wasn't really a housing boom in Arkansas.
Yeah.
I mean, there are a few areas that had a lot of growth and a lot of new housing, but for the most part, I mean, I live 5 minutes away from the farmhouse where I grew up. And when I go out for a run or I'm driving around town, the homes that I see today are the exact same homes that I saw 30 years ago when I was a little boy riding my bikes around those streets. And there's lots of places like that around America that were not a part at any level, at any part of the value chain in the housing industry on the housing collapse. Yet they are bearing a lot of the negative consequences of the Dodd-Frank bill.
Let me switch, we talk about Dodd-Frank endlessly. Right now, over at the Center for American Progress, Department of Labor is reducing their fiduciary rule. They just tweeted the text out. I have not seen the whole thing. I think we have a pretty good handle on it. Senator Cotton, let me start with you. I know you guys, I know Commissioner Pevar probably has a view on this as well. Start with you, Senator.
Well, he'll have the expert view. I'll just say that I've heard repeatedly from the investment professionals in Arkansas who say this is going to severely impact not just them, but more importantly, the people they serve. Middle income, lower middle income families who don't go into, you know, what the big banks might call private wealth management, or, who are going to be categorized as ultra high net worth individuals, who have a little bit of savings. And I don't know. It's hard for me to see what problem the Department of Labor is attempting to solve with this regulation. But I'd turn it over to Commissioner Peerwar for the expert.
Well, not having seen what they've said, what's exactly the rule, I can imagine it's either bad or terrible. So it's one of the two. I can't figure out. But what's so disappointing is that, as Senator Cotton mentioned, was that they failed to listen to all the voices, the bipartisan voices that were coming from the Senate and the House, whether it was Senate Republicans or the Congressional Black Caucus, about concerns about, as Senator Cotton mentioned, the raising the cost of providing these services, and the service providers are simply going to probably end up shedding some of the small dollar amount accounts. And so, if the concern was they weren't getting, exactly optimal, advice, however you measure that, whatever it is, we're going to potentially end up in a situation where you go from that to no advice is being provided. And how are we serving these people in those communities? And Kyle, you mentioned fintech in part of your remarks. Maybe we'll talk about that a little bit later. But one of the things that we're seeing in fintech is the so-called robo-advisors, or the ability to use technology to lower the cost of providing this advice. And at the same time, moving to the fiduciary standard, we're seeing things from, for example, the Secretary of State in Massachusetts calling into question about whether robo-advisors can, in fact, provide a fiduciary duty under their state registration laws. And so it's going to just continue to end up raising the cost to these small dollar accounts, to the point where a lot of them are just going to be shed and people are going to get no investment advice.
We just had 2 points. Number one, we have seats up here for any of y'all sitting in the back. There's probably about 8 empty chairs right here. Also, this is scheduled to 1:30. We're probably going to end about 1:15, so we'll have time to chat. Okay, so that's also good news for those of you in the back. You mentioned private wealth management. What's interesting about this, remember we keep talking about big guy, small guy? If you know anybody who works at the elite private wealth management units, Goldman Sachs, Morgan Stanley, depending on the place, you need maybe $5 million in liquid assets just to call them, just to start the conversation. Those folks, today's event at the Department of Labor fiduciary rule is not a big deal. Some of them don't even know about it. They might have read about it in the paper. Their clients, as you might imagine, are the 1% of the 1%. This is not a big deal to them either. It sure is a big deal to somebody that advises a $20,000 IRA or is going to take the account. Someone's daughter who has a $6,000 IRA, and he knows the dad from the Kiwanis Club or the Elks Lodge, and he'll do it, just out of relationship purposes. The fixed costs going on and on. It's just like community banks. There's fixed costs. Big person can afford it, little guy can't, and that is who we hammer. There's probably something to address with the Department of Labor fiduciary rule. That is Main Street Growth Project view, that you can do something to affect the people who have taken advantage of those, and you should throw the book at them. It's absolutely right. But again, there's unintended consequences, and it's only the little guy who deals with it over and over again. Some good news, I think, in general, and I'm struggling to find some in some cases, but Secretary Lew, the Secretary of Treasury, has mentioned that there's things that there were unintended consequences of Dodd-Frank, wants to deal with them another way, right? There are a number of Democrats who have bills to change. I mentioned Ross Delaney earlier. There's a number of community banking bills. And I just want to go back to this point, Senator. Is it falling in love with your first draft? You mentioned the legacy of the President, Obamacare. They did change Dodd-Frank a little bit in 2014, and I've noticed the stuff that got through is not Dodd-Frank, even though it could have been. Jobs Act. Congressman Tipton, community banks can go to an 18-month cycle instead of 12 if they earn it. Fabulous bill, didn't touch Dodd-Frank. Is this just falling in love with your first draft, saying we can't change another comma until the president's gone?
I think there's some element of that, and obviously it's the influence of Senator Warren in the Democratic caucus as well. I mean, the CFPB in particular was her baby, and to the extent that you have changes to the Dodd-Frank law, it socializes the fact among Democrats that you can have more changes. Now, I do hope that that will ultimately recede. There are 2 pretty significant changes to Obamacare last year, for instance, the so-called Cadillac tax on high-value insurance plans and the medical device tax. That suggests to me that Democrats are tired of taking a beating on Obamacare after 6 years. And with the president on the way out, they're no longer going to sacrifice themselves on the altar of Obamacare. I hope we'll begin to see that as well with Dodd-Frank. It's a big bill, does a lot of different things. A lot of the reforms we've discussed or that I've seen in the Financial Services Committee, now the Bank Committee, are relatively small parts of it. I would hope that a lot of Democrats decide there's no continued reason to sacrifice themselves on that altar. But I mean, you've also seen the influence of Bernie Frank in the party as well, in the presidential primary, as well as the influence of Liz
Bernie
Warren.
Sanders, yep.
Bernie
Yeah.
Sanders, yeah, sorry.
Absolutely.
Bernie Sanders in the presidential campaign and Liz Warren here in the Senate. So there might be some continued leadership on their side of the aisle to protect Dodd-Frank exactly as it was handed down in tablets from the mountain. I hope that's not the case.
The one thing I want to add is some of you may be saying, well, Dodd-Frank was passed almost 6 years ago. Isn't it already, it's written in stone. Aren't we already done? Is it already too late? And the answer is no. What Dodd-Frank did in the 2,319 pages was basically told a bunch of regulators to promulgate about 400 new rules, of which the SEC is responsible for about 100 on a joint or individual basis. 5.5, 6 years later, we're only 2/3 of the way finished with Dodd-Frank. So what that means is that 1/3 of the rules are yet to get written. So there's an opportunity for Congress to address those rules that are proving difficult and improving, that the regulators are recognizing they're going to be extremely costly to try to fix or repeal those particular provisions. And even of the provisions that are already, that we've gone final on, a number of them, the compliance dates or effective dates haven't hit yet. So on the plus side, there's an opportunity, even with some more time to try to fix these things. On the minus side, if we don't, the costs and burdens of these things are going to get worse before they get better.
If I could just add as well about the Dodd-Frank law, and this applies particularly to the CFPB, but so much of that law, as Commissioner Pivovar said, just directed regulators to take further action, which is a constitutional abomination. We have 3 separate branches of government. Our Congress is supposed to write the laws. Our president is supposed to enforce the laws, and our courts are supposed to interpret what Congress did and adjudicate what the president proposes to do. Laws are standards of conduct that bind all of us and have a penalty attached for violation. When Congress tells the SEC or the CFTC or the CFPB, go write a rule and then also enforce it and then also adjudicate it, it is what Madison called the very definition of tyranny. The power of all 3 powers of government in the hands of one agency, particularly at the CFPB, which is largely insulated from any kind of effective congressional oversight because of its one-person structure as opposed to a commission like these gentlemen serve on, because it's insulated from the budget cycle of Congress and so forth. I know there's still litigation moving on about that in particular, but I just want to say it's really a shame that Congress shirks its duty so often to pass that responsibility on to unelected regulators. That's not the way it's supposed to work. We're supposed to write the standards of conduct, and we're supposed to face our constituents back home in our states and our districts to evaluate our performance on that.
Yeah, Main Street Growth Project, we're going to shout it from the rooftops, tell as many voters in any way possible. There are Democrats who agree there are changes that can be made. Dodd-Frank can be changed. You mentioned it got set down from the tablets, you said, it came down on tablets from up on high. There's no reason to let ego or falling in love with our first draft stop economic growth and cost all those people I mentioned, the young people, the mom returning to work, the immigrants' jobs, just because we've fallen in love with this thing and can't change it. Neither Dodd or Frank are in Congress anymore. If the U.S. Constitution can be amended, if they can add a New Testament, if they can remake Point Break, we can change Dodd-Frank. You mentioned tyranny. Let me ask you this. One thing I always hear, I'm sure you hear it, and here's my question for all 3 of you guys. Whenever I want to do an event like this and I ask people, you know what I hear? And it's probably the worst news I heard I'm going to say all day. They're afraid to speak out. They're afraid of their regulator. Do you hear that?
I do, in particular in the banking world with small banks. I mean, the CFPB, in my opinion, is a constitutional abomination. At a minimum, it should be put on congressional budgeting cycles, and it should have a 5-member commission as opposed to a director. But it was a challenge, I know, for lawyers who wanted to confront the CFPB in court to find any bank who was willing to be a plaintiff because they were worried about a call from the regulator. I mean, banking is inherently more regulated than most industries because governments create money. And therefore, from the very beginning of our country, banks have had a tighter relationship with the government than agriculture or manufacturing or what have you. And lots of great moments in political history, like the first bank and the second bank and so forth, because banks are inherently more regulated since government creates money. But banks shouldn't be intimidated from exercising their other First Amendment rights to try to petition the government for redress of grievances. whether it's at the Bureau or whether it's coming to their elected representatives or whether it's challenging what they deem to be an unconstitutional action in court, yet I've heard frequently that they are.
Commissioner?
You know what? I recall a conversation I had with a group of family farmers on a farm in Shelby County, Kentucky, last fall. And I asked the farmers, I said, what is it about our rules that really are the most troublesome? And what they said was fascinating. They said, it's not so much the rules that you write and publish, it's everything else that we don't actually know until we try to get something done. And then we find out, oh, there's a no action letter on this, or there's staff guidance on this. People talk about shadow industries, shadow regulation in the form of unwritten, unaccountable, no action relief, interpretive guidance, statements by regulators that haven't gone through notice and comment, there hasn't been an opportunity for the public to weigh in, are really a problem, a growing problem for participants in the marketplace. They don't know what the rules they're up against are until they actually take action to do something. Then they suddenly find out, oh, well, there's a no action letter that prevents you from doing this. There's staff guidance. And it's so that changeability, that inchoate, unsubstantial set of body of rules and regulations that are growing and growing, that are really a problem for certainty in the marketplace. As a former businessman, I can tell you, the one thing you ask for in business is just to know the rules of the game so that you can proceed in accordance with the law. Well, if the rules of the game are not published, if they haven't been announced with allowing people to comment and get them right, you just bump into them when you go about your business, that's a real problem. It's a growing problem.
Senator?
And I'd say when you have that kind of shadow regulatory action or enforcement guidance that is not occurring, through notice and comment rulemaking and goes into the Code of Federal Regulations, who can manage that? In fact, some ways, who gets a competitive advantage from it? The biggest banks and the biggest financial institutions who are served by the biggest and most sophisticated law firms. Who can't handle it? The farmer in East Arkansas who has a country lawyer who thinks he has all the materials he needs to advise his clients in one title of the U.S. Code and a couple titles of the Code of Federal Regulations, and has a low-cost subscription to Westlaw or Lexis. They're the ones who can't handle it. And you see that in industry after industry after industry. More regulation from Washington tends to favor the biggest, wealthiest, most sophisticated players and tends to hurt the small farmers, the small businessmen who are trying to comply with the law, and oftentimes they just simply can't know what the law is.
Yeah, when I was working on the Senate Banking Committee, there was an instance, I forget what the exact rule was. It was involving the CFTC, and it was one of these sort of shadow regulations. And we asked, well, how are you going to let people know? How are you going to make people aware of this? And they said, oh, we let people know all the time by subpoena. And so people who, and they were serious about this, right? And this rulemaking by enforcement is, it's troubling. It's exactly to your point. When stuff gets done by rulemaking by enforcement, it benefits the big guys. It benefits the people who are the ones that are negotiating the settlement, and then everybody else all of a sudden has to comply with those particular things. It's something that I try to guard against in terms of the enforcement actions we do. And your original question was about being afraid of the regulators.
Yeah.
We saw during Dodd-Frank, there were many times on the Senate Banking Committee, and I see a lot of colleagues here who are also on the House Financial Services Committee. We had a number of firms come up to us and say, this is crazy, and we said, well, why don't you fight it? Try to push back on this and lobby against it. And they were afraid of the administration coming down on them through whether it was taxes or antitrust or some other sort of thing. They continue to be afraid of the regulators, of the power of the government coming after them, which is a shame in this country. And all I got to say is, thank God for MetLife. This was one insurance company who was in the woods, out there by themselves, fighting against the unaccountable capital markets death panel known as the FSOC, right? They fought and they won. And although we don't know the exact reasons why the judge ruled in their favor, we got some hint on that. Apparently, it's going to be unsealed any day now. We'll be able to find it. Thank God for them. Hopefully, it's a game changer. That hopefully, folks will see that you can be brave, and if you come with arguments and you actually come with the Constitution in hand and say, look, these agencies have to follow the constitutions, that you can't win.
Jim Purcell, the small-town banker from Texas, who's kind of famous these days, suing the government, similar to MetLife, different suit. Tiny bank in Texas, and he said in his very sort of Texan way, he says, people keep applauding him, but nobody wants to join him. The way he says it, though, is, everybody wants to hold my coat, nobody wants to get in the ring, right? We should never hear that in America. That's an old Czechoslovakia line, maybe Soviet bloc. We should never have to hear that here. Afraid of your regulator. Last thing, Senator Cotton, I know you have to go. You mentioned Senator Warren earlier, and we're talking about the little bank struggling. Profit margins down. Life is difficult. If you're the small town banker, life is not as fun as it used to be. Because you see these folks every day. When that little bank is now for sale because life is difficult and expensive, and they get bought, for less than they would otherwise because there's regulation. Does Senator Warren know that when she goes home at night, what one of the effect of her activities is to put money in the pocket of the big bank that bought the little one?
I mean, I would hope so. I mean, she's a very
It's just a fill-in, by the way. It doesn't have to be just Senator Warren, but
well,
a
I
viewpoint.
hope so. She's a very smart woman, and
Agree.
she has big financial institutions in the Boston area, but she has those very same small banks and other small institutions out in rural Massachusetts as well. It's just a typical example of liberal approaches to public policy that so often end up hurting the very people they're trying to help, and helping the very people they're trying to afflict.
Yeah, I read her book, by the way. I bought it. It's quite good. Two-income trap. Does Senator have to go?
Oh, I guess I have to run.
I know that look.
Kyle, thank you very much.
Thank you
all
for
for letting
having
me come
us.
visit with you, gentlemen. Thank y'all.
All right. All right. We'll do about 2 more questions, and then we're going to stop. Again, we have it till 1:30, but I want to give time for us to speak informally. I know there's a lot of folks in here that know each other, didn't have a chance to talk. One last thing, guys, both of you, about both commissioners, the no bankruptcy reform in the FSOC SIFI process, it makes people in D.C. more powerful, and they don't let SIFIs out that are in. You mentioned MetLife. They make it difficult to determine what makes you one. It doesn't seem like Dodd-Frank's own purpose to reduce systemic risk is being served when you make it so difficult to know how to not be a SIFI and how to get out of it when you are. If I didn't know any better, I think regulators want the power. Why do you think this is the case?
I mean, I don't know what motivates people for power, but
Sure.
I mean, it's absolutely right. I mean, if you look at the statute that created the FSOC, it's unconstitutional the way the structure is set up in the process, right? And I've been very public about the fact that the structure is not only odd, but it doesn't work in the fact that we have independent regulatory commissions where Commissioner Giancarlo and I sit on a bipartisan commission, and by statute, the president has to name commissioners from 2 different parties, yet the FSOC invites only the chairs from the agencies to come and vote on these SIFI decisions. We have absolutely no voice. We have absolutely no ability to know what they're doing inside that star chamber. We have absolutely no ability to get information about why they made those choices. I tried to get information about the MetLife decision. I wanted to see what MetLife presented because I heard it was a very good rebuttal of what they did. And in fact, the judge voted with them. I could not get it from the FSOC. They wouldn't give it to me. I could not get it from our chair's office. And, and MetLife couldn't give it to me directly because they'd be subject to FOIA, and we get all the reporters asking for all this stuff, so couldn't get it from there. It's clear that both the structure and the process in which they designate is flawed. Now, having said that, there are some bills out there that would fix both the structure and the process of the FSOC.
Yeah, absolutely.
And it should be garnering bipartisan support. And I hope that the MetLife decision is actually a game changer, because those that actually support what the FSOC is trying to do should see that the court has struck down both the structure and the process, and so they would want to hopefully fix that, and we'll see what happens.
Commissioner?
There's other duties that the FSOC has in addition to designating SIFIs. It also is meant to serve as in a coordinating role to coordinate all the myriad of capital and financial regulations that are hitting our American capital markets. Mike Pivovar and I did a joint op-ed in the FT about a year ago, pointing out that liquidity is drying up in a lot of key capital markets, especially the bond market here in the United States. Markets that are critical to our economics and our American way of life, and the ability of the U.S. dollar to remain the world's reserve currency. If that liquidity dries up, the dollar's reserve currency status will be challenged. And yet, FSOC is the one that's supposed to be coordinating rules that are coming out of Basel and the Basel Committee in Switzerland, that are coming out of the FSB, that are coming from his agency, my agency, that are part of Dodd-Frank and are part of other things that have come since Dodd-Frank. And yet FSOC is asleep at the switch in terms of coordinating all of that activity level and dealing with the diminishing liquidity in our U.S. capital markets. So perhaps now, with MetLife out of the way, FSOC will have the time and the attention to give to this very important question of coordinating the regulatory impact of all of these rules on U.S. capital markets.
Would love to see bankruptcy reform added as an option. Would allow those with skin in the game to actually be in the room, creditors, shareholders, et cetera. I'm reminded of the old Herman Cain line. He said, two bad things about Dodd-Frank were Dodd and Frank. But he's being a little flippant, obviously, with that. But the reality is it's not the worst thing. The worst thing is the effect on a little guy, and people don't realize this. A lot of folks don't. And that's what we're about every single day. Last thing on FSOC, do you guys have any idea what would happen if the next Lehman happened over an inauguration? The Secretary of Treasury is the sort of the chair of the Star Chamber, right? The group room. And everybody's going to be wondering what's going on in that room. What's going to be, Kremlin watching, right? What are they going to decide about, say, the next Lehman, right? Whatever firm it is. If the head of it is somebody who, after Inauguration Day, is going to be somebody with possibly a completely diametrically point of view, right? Let's say it's President Obama followed by, President Cruz or something like that. How on earth are markets supposed to react knowing that on that day they're going to switch? And remember, these people have totally opposite points of view, the new Treasury Secretary and the old one. Any idea how that would work?
That's a hypothetical within a hypothetical.
Yeah, I know.
I don't think I can.
Yeah, it would be a wreck. But anyway, well, let's leave time to talk informally. Guys, join me in thanking Commissioner Giancarlo and Commissioner Pivovar. Thank you.